Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's a mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.
All right, so welcome to Mortgage Mom Radio. I'm Debbie Marcoux. I am the Mortgage Mom, and every week I am bringing you guys information about what is going on in the market, and especially things that are going to drive a change in our mortgage and real estate world. So what is obviously the hot topic right now are mortgage rates. So we are going to be talking about that today. They have come down a bit. We did go over the Federal Reserve Prime meeting last week, and I did say in my show that I did feel like we were starting to get to a turning point, although they did not come right out and say that. And now we are starting to see more evidence of that turning point as I had predicted. So we are going to talk about that today because mortgage interest rates are definitely on their way down. We are also going to discuss credit card debt, consumer debt, and what should you be doing right now to get yourself into a position to get yourself freed up of some of that debt, especially if you are a homeowner. And then even more, we've talked numerous times on the show about trying to get ahead of the market. You want to be out looking at homes before a slew of additional buyers gets to there first. And now you've got tons of competition. So this is what we are going to be talking about on today's show. I do want to remind everybody that you can go live with me. And if you do have questions, please feel free to put those into the feed. I will read them out loud and answer them for you. We are an interactive show. How do you make sure that you know when I go live and you're not relying on YouTube to send that notification or Facebook to send that notification and you happen to miss it? Well, get a text message from me. Text the word live, LIVE, to 844-935-3634. That's 844 We Lend for You. WELEND and the number 4. Now that is also the phone number to call my office. So if you'd like to speak with me or one of the girls on my team, please feel free to call the exact same phone number. Also, I want to remind everybody one more time, because I've actually gotten a couple of phone calls here recently saying, I'm not getting your text message anymore, and I used to like watching the show. What happened? Okay, so I do want to remind everybody that I am no longer sending a notification out to anyone who has opted in to the word mom. So if you had text messaged me back 3 months ago and all the way 5 years before that, for that monthly or weekly reminder that we were going live, you've got to do it again. You've got to opt yourself in again because we have changed the messaging. We've changed the list. I want to make sure that I am only bothering those people that want to be bothered. So we've started from scratch. So make sure that you text the word live, LIVE. One more time with that phone number. It's 844-935-3634. That's 844 We Lend for You. WELEND and the number 4. So we are going to jump right in. Why are mortgage interest rates falling and what am I predicting moving forward? What are a couple of more things that we need to be on the lookout for that are coming in the next few weeks? We're going to talk about that turning point. We're going to talk about mortgage applications. We are going to jump all right into it. So we are going to take a super quick commercial break. And when we get back, I'm jumping right in. 2 feet. Let's go.
She's a mortgage mom.
This is Debbie Marcoux, the Mortgage Mom. Well, I've had a lot of questions lately. What can I do to bring my monthly payment down until interest rates get better? Well, if you are a buyer and you're out looking at homes, What you want to focus on is a program called a 2-1 buy down. If the market rate today is 7%, you would start your first year at 5%, year 2 at 6%, and year 3 through 30 would be at that 7%. It's a great way to enter the market today, knowing that rate cuts are just around the corner. Give us a call or head on over to our website at mortgagemomradio.com.
Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926.
When you're in need and don't know where to go, pick up the phone and call Mom.
All right, so welcome back to Mortgage Mom Radio. I'm Debbie Marcoux, and let's jump right in. Why are mortgage interest rates improving? So last week, the Fed met on Wednesday, and on Thursday, we actually received our unemployment report. And it was actually Thursday or Friday, so I'm going to take that back and say at the moment in the studio, I'm off on my days. So it was either Thursday or Friday, but our unemployment report did come out. And it was the first time that that unemployment report came out where things were worse than expected. There were less jobs created than what they were anticipating to see on the most recent levels in the most recent report. So with that, that starts to get the market excited. As I've talked about in recent shows and previous shows, we look at mortgage rates are tied to the market, very much like stocks. There are things that can happen. There are reports that can come out. There is news articles that can come out that can spark stocks to go up, stocks to fall, certain stocks to behave better than others, and mortgage is exactly the same way. So when things come out that the market, the investors are looking at and trying to read between the lines and determine what is coming, what are they predicting, what are they seeing for the future, they're watching these types of reports. And so one of the things that was mentioned in the last Federal Reserve meeting in the statement from the Fed Chair Powell, he said that he's looking for the economy to start to cool off. And that is not just in spending, but that is also in jobs, inflation. He's looking at all of those different things, all of those different reports. Well, this is the first time that we have actually had an unemployment report that came in lower than expected. So now you've got many investors that are starting to read into this. Okay, well, if jobs are not being created as quickly, that means that we're cooling. There's a very good chance that maybe inflation is going to be a little bit better at the next report. And as I said last week in my show, I'm expecting that I'm going to see the next inflation report come out to either be equal to and level, not worse like the last two have been, or possibly even improve a bit. And why do I say that? Well, I keep telling you guys over and over again that I want you to slow your spending. I want you to only spend on what you need to, not what you want, right? If it's not a necessity, just don't do it. But I do believe that we are seeing people slow their spending, even not listening to me, because again, I don't have a big enough voice to get out there and for everybody to listen to me. But why do I think that? So I thought, you know what? It'd be good for me to actually explain to you guys, where am I reading into? What am I seeing that is driving me to this information, right? So the first thing that I notice is that we've got a lot more credit card debt than what we used to. And as your credit card debt climbs, obviously many people will start to run out of spending limit, not have enough. With inflation and interest rates being higher, your interest on those credit cards, student loans, car loans are higher. You're paying more every single month. We're all feeling it. We're feeling that pinch. And those credit cards, just in general, just looking at nothing but credit cards, they are up substantially, and the amount of debt that we have as consumers on those credit cards is also up substantially. So in my opinion, I think that just being limited to the amount of credit that the American can access, we're going to see people slow down on what they're buying, because if they don't have the open credit to do it, then they're not going to be spending as much as they were. So for example, and I pulled this article for you, this is one that I read, that I keep up on. This is from the New York Federal Reserve Bank of New York. And they're saying, we're going to release our Q1 2024 household debt and credit report on Tuesday, May the 14th at 11 a.m. So we're going to see our next report from them talking about the consumer debt and overall credit of the American consumer next week on May the 14th. And I'm going to expect that it is going to be worse than the last report. So the last report that we saw was household debt and credit report of Q4 2023. And it says household debt reaches 17.5 trillion in the fourth quarter. Delinquency rates rise. Total household debt rose by 212 billion to reach 17.5 trillion in the fourth quarter of 2023, according to the last quarterly report on household debt and credit. Credit card balances increased by 50 billion to 1.13 trillion over the quarter, while mortgage balances rose by 112 billion to 12.25 trillion. Auto loan balances rose by 12 billion to 1.61 trillion, continuing an upward trajectory seen since 2011. Delinquency transition rates increased for all debt types except for student loans. Well, why have student loans not actually fallen to delinquency yet? Well, because many of them have been on deferment and many of them actually are still on deferment. So we want to take student loans out of that. But when I'm reading reports like this is what's telling me that our debt is going up. As consumers, our debt is going up, our debt is going up, our debt is going up. And, eventually there's just not going to be any credit available to continue adding to that debt. Then we start to fall into delinquencies, as they've mentioned here. And so people just are not going to be able to spend as they were previously. So that brings me to, hey, I do believe we are at that tipping point, as I had mentioned previously. I believe that we are right there where the Federal Reserve at the next meeting is going to have to look very, very closely at the economy to determine whether or not they should hold one more time or whether they should cut. There are many analysts right now who are actually starting to hedge against and bet against, which we all know that they do in the markets, that they're going to actually do a cut at this next meeting. Now, I still don't believe so. As the mortgage mom, I still don't think that we're at cut time at that next Federal Reserve meeting in 5 weeks from now. But I do believe that we are very, very close. And I think personally that it might be the actual meeting after that. So what does that tell you? That tells you that as soon as they start to cut interest rates, we are going to start seeing more and more and more people start to jump on the opportunity of purchasing a home. Now, this show has been a lot around purchasing, so I'm only going to give you guys a couple of words on this one today. If you haven't started looking into what you need to do to get prepared to purchase a home and you have been wanting to, this has been your goal, you have put it on hold, you have been waiting for the right time, take it off hold right now. Sometimes a pre-approval can take 3, 4, 6 months. It depends on you. It depends on your credit. It depends on your income. Many times we are building plans for success. So you are talking with us, you are doing that consultation. Many times you're completing that application. And then we are giving you the plan. We are giving you the roadmap to be able to get to the point in which you can be pre-approved and out on the street and looking at property. Sometimes you're pre-approved within the same day, hours, and you never even knew that you were ready or that you could go and do what you needed to do. But my advice to you would be, I am reading the market. I have been doing this for a long time. You guys have all been listening to me do this. I have not been very far off on any of the predictions that I have given you guys. And I am telling you that we are close, that we are around the corner from interest rates starting to be cut. That is my opinion as the mortgage mom. So if you've been thinking about that, that has been a goal. I want you guys to seriously consider getting your plan started. At least reach out and get the consultation. It's super simple to get a consultation with me, Heidi, Heather, one of the girls on my team. It is so easy, and you can talk with one of us directly. We are available for you. go to our website, go to mortgagemomradio.com and book yourself an appointment. You can literally book yourself a phone consultation right on our website. So mortgagemomradio.com. Now, I do want to also talk about this consumer debt. And there are a lot of people that are listening to the show, who watch the show later, who listen by Go Country on Saturday morning, who are homeowners. And so we're going to talk about debt as well, because many of you are starting to swim in debt. Many of you are really at that brink of you're almost ready to not be able to make a payment. We do not want you in that position. We have got to do something before that happens. So we are going to take a quick break. The first thing I want to do is say hi to Michael Manriquez. He did jump on and said, hello. I know it's been a while since I've been here. So Michael, thank you so much. I love it when you jump on. Appreciate that you do watch the show. But we are going to take a super quick break. And when we get back, we're going to jump into that consumer debt. So stay tuned. We'll be right back.
She's a mortgage mom.
This is Debbie Marcoux, the Mortgage Mom. Well, I've had a lot of questions lately. What can I do to bring my monthly payment down until interest rates get better? Well, if you are a buyer and you're out looking at homes, what you want to focus on is a program called a 2-1 buy down. If the market rate today is 7%, you would start your first year at 5%, year 2 at 6%, and year 3 through 30 would be at that 7%. It's a great way to enter the market today, knowing that rate cuts are just around the corner. Give us a call or head on over to our website at mortgagemomradio.com.
Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926.
When you're in need and don't know where to go, pick up the phone and call mom.
Okay, so welcome back to Mortgage Mom Radio. I'm Debbie Marcoux. I am the Mortgage Mom, and today we are talking about interest rates. Why are mortgage interest rates getting better? And I didn't really jump into that one. I just kind of gave you guys reasons for what's happening, how it works. So I do want to talk about that very quickly. We have seen a nice decrease in the interest rates since that unemployment report did come out, and we have continued to see those gains throughout this week. So it is Wednesday. Our interest rates did get better last week at the end of the week. They got better on Friday. They got better again on Monday, got better again on Tuesday, even got better again today, Wednesday. And even though today was actually a bond auction sale day. So that was another thing that was talked about in the Federal Reserve statement last week, was that they were going to actually come June 1st, they were going to start to slow the amount that they were selling off of the balance sheet as far as those treasuries go. So today was actually still another huge sale day. And typically when we see those sales days come, and they're doing those sales of those treasuries, we usually see interest rates get worse that day and for a couple of days afterwards. Because of course, if they're not holding the treasuries on the balance sheet and they are selling them, and in today's market at a discounted price, then the actual mortgage rates do get worse typically. So today we actually saw that they did do a sale, but our rates haven't changed. They are actually still quite a bit better than they were this time last week, last Wednesday before the Fed met. So we are seeing interest rates get better just because basically every indicator that is there that is signaling that we are getting to a turning point is showing positive. So we're getting to that turning point where the economy is cooling. It is slowing down. The spending is slowing down. The debt is up. American consumer debt is up. All of the things that unfortunately the Fed wants to see is starting to come to fruition. So really what we are at a point now that is going to be very, very important is that we see inflation come down further at the next meeting. We see unemployment stay, not get better, right? We want it to be worse than the last, just like the last report, we want it to be worse than expected. We want to see that spending slow down, but all of the signs are there that this is happening. And so that is very, very exciting for me being in this industry, thinking, we're almost there. It's coming. It's coming. It's coming. We're all going to see some relief. We're going to see interest rates come down. We're going to be able to help those who have this consumer credit card debt, like I mentioned, be able to start to refinance their home that has a ton of equity in it, because just about everybody right now has got a ton of equity. Americans are sitting on more equity in their homes today than has ever been in all time. So, you've got equity in your home that you could tap into. But consumers are choosing not to tap into it because interest rates are so high. They don't want to refinance. They don't want to lose that really low interest rate that they were able to get during the pandemic. So we are not seeing people actually relieve themselves of the debt, and they are just struggling and struggling. So I do want to talk a bit about consumer debt and some of the things that you could be thinking about doing right now, especially if you are a homeowner who is sitting on a lot of equity. You may, at this point in time, consider looking at a home equity loan or a home equity line of credit to try to get that debt paid off. So many of you are sitting with credit card balances that are maxed out, personal loans that you might have taken that have high interest rates on them. You may have credit cards. Not credit cards. Obviously, we all have credit card debt at this point. You may have car loans at this point that are in high interest rate percentages. So we want to look at all of those things and see if it is possible to maybe tap into your equity, not by doing a complete refinance, but doing an equity line of credit or a home equity loan to get that debt paid off. Remember that your credit scores are probably hurting if you are maxed out on those credit cards. If you are at your limits of what your credit card says, hey, you have $10,000 that you can spend and your balance is $9,700, your credit score is lower than what it could be if you are at a much lower percentage of what you owe versus what your credit availability is. So if we can get that credit score up, then there's going to be more opportunity when interest rates do come down to do a debt consolidation of your current first mortgage with a low interest rate and a new equity line or equity loan with a high interest rate. We will be able to do a consolidation here probably within the next anywhere from 6 to 18 months and probably more like 12 months. But we've got to do something to get you guys some relief, some monthly cash flow going. We need to get the credit score up. We need to get you guys breathing again. And so you may consider tapping into some of your home equity to get that debt paid off, because we know that many, many consumers out there right now are very high in debt. So if you are feeling that way, if you're feeling pinched, if your credit cards are maxed out and you are trying to figure out what can you do, what would be an option, there's always personal loans as well. So you can always look at a personal loan. Personal loans will typically have a much higher interest rate than a home equity line or a home equity loan would have. And they will usually be for a shorter term. They will usually be for a 5 or a 6 year term, maybe 7 years sometimes. So keep in mind that a home equity loan, to, compare the two together, a home equity loan, you're going to choose how long you want that loan for. So do you want it for 10 years, 15 years, 20 years, 30 years? And depending on the amount of years that you set it up for, can make that monthly payment to pay that debt off much lower than what you would pay in a personal loan. But again, a personal loan would be something that could help you consolidate that credit card debt. So you might want to start thinking about that. Home equity lines and loans are something that's very good to try to get those things paid off. And again, we're so close right now to interest rates starting to come down that I don't think you'd have to have that home equity line or home equity loan outstanding for really more than probably a year. Let's call it 18 months to be really, really conservative before you would have the opportunity to be able to refinance that first mortgage that you have, that home equity line or loan that you'd be taking out now to rid yourself of that debt, and be able to consolidate them all into one even lower monthly payment than what those two payments would be costing you today. And now those two payments, again, it doesn't make sense to do it unless it would be saving you money over and beyond what you are paying on the credit card debt that you have. So things that we're going to talk about during a consultation, something that I want to make sure that you do have available when you do make a phone call or you schedule an appointment to speak with us. Make sure that you've got all of your statements pulled for every debt that you might have. So if you have a personal loan, have your most recent statement pulled. If you have credit card debt, have every single credit card statement pulled, the most recent statement that you have received. If you have student loan debt, make sure you've got those statements. If you have car loans, make sure that you have those statements. If you have a trailer or an RV or a boat, any debt that you have, period, end of story, make sure that you have all of those statements readily available right in front of you at the time of the phone call, whether you're just calling the office and hoping to get somebody right away, which happens all the time, or even if you schedule yourself a phone appointment on our website, make sure you have those things in hand because it makes our consultation that much better. We are going to take our time with you and ask, how much do you owe on it? What is the interest rate on it? How many years do you have remaining on it? And we are going to plug all of those numbers in to our blended rate calculator. And we are going to tell you, based on everything overall, how much interest are you paying monthly and what is your total interest rate that you are paying monthly? What is that blended interest rate? From there, we're going to start pulling things out. Well, this one's a great interest rate. We don't want to touch it. You've only got 2 years left on it. Ooh, this one is 33% with your Capital One. And so we are going to do that consultation with you that is for you. It is very individualized and it is important that we're doing that with you. So make sure that you have those tools available for us so that we can help you to the best of our ability and get you pointed in the right direction. I can see Armando jumps on and says, can't wait. I'm looking to do a consolidation loan at a good low rate. And yes, it is coming, Armando. You guys got to keep in touch with me. You've got to make sure that you guys are watching all of my social media, whether you're following my Facebook, my Instagram, my TikTok, my YouTube. Make sure that you guys are following me. You can always find me. It's Mortgage Mom Radio. Just type it into the search. I will come up. But make sure you guys are following me because obviously I'm putting out content just about every day and you're going to know immediately when we get to that very first rate cut. I'm going to start talking about averages, interest rates, what we're seeing, refinancing, purchasing, but it is just around the corner. So for anybody who has not bought a home yet, you are a low down payment borrower, you are wanting to utilize down payment assistance, you are a vet with zero down, you need help with closing costs, right now is your opportunity to be able to negotiate with a seller to get those things. As soon as interest rates start to come down and you have got a lot of competition and multiple offers going into every home that you look at that you want to write on, you are not going to have the opportunity to ask for closing costs. Sellers are going to select the strongest offer. So unfortunately, where I believe that we should be giving veterans the best opportunity to get a home, get an offer accepted and to close on a home, they deserve it. They should. Sellers, unfortunately, they're looking for that strongest buyer in a multiple offer situation. They're looking for the bigger down payments. They're looking for the all cash. They're looking for the non-contingent borrower. So if you are somebody that's going to sell your home to buy the next, you might be thinking about getting that home listed for sale now rather than waiting longer. Because when you become that contingent buyer, like we talked about in last week's episode, it makes it more difficult for you to try to get an offer accepted over the buyer that has 10% down and no contingency because the seller doesn't want to worry about a deal falling out of escrow. A zero down payment loan, down payment assistance, veterans, FHA, low down payment borrowers in general are not as strong of an offer as somebody that's coming in with a large down payment. So if you guys have had that as a goal and you've put it on hold and you just didn't think it was the right time, please listen to me after all of these years of me being online and giving you guys the advice that I have not been wrong about. Get ready, get prepared, get your application started, get your consultation. If you have a bunch of debt, get it consolidated. If you own a home and you're sitting on a ton of equity, do something about it. Do not miss a payment. Do not let your credit score drop. There is so much that you guys could be doing right now to get prepared, and you should be. You absolutely should be. So with that, I am going to stop this show. I'm trying to keep it to 30 minutes to make it a show that everybody wants to jump on and watch so that it doesn't go on for an hour. But we are open. My website, you guys can go there, get an appointment. Happy to meet with you on Saturday, on Sunday. If you don't see an appointment time that works for you, you need a later evening appointment, you need an earlier morning appointment, not a problem. Send me an email right through that website. You can hit contact us, and that is going to come directly to me, to the Mortgage Mom, and I will schedule an appointment for a time that works for you, as long as it is not 11 p.m. and I'm in bed. But other than that, we will make it early morning. We will make it, even later evening. We will do it for you. MortgageMomRadio.com. Hit up the website. I hope you guys enjoyed today's show. I hope I gave you valuable information, and I'll be back right here again next week, Wednesday, 1 p.m. on YouTube. Talk to you guys all.